Okay, so you want to own a car wash. Find a corner lot, put in a tunnel, watch the cars roll through. It looks like the simplest business on earth. Water, soap, a conveyor belt, done. Drive past one on a Saturday afternoon, and you'll see a line of cars backed up onto the street, vacuums full, a kid running the pay kiosk. You watch that and think, this place must print money. More cars, more cash. Simple. Here's the problem. You are looking at the 1 hour of the week that lies to you the most. The truth is, a modern car wash is not really a car cleaning business. It is a subscription business attached to a piece of real estate that happens to get your car wet. And once you see it that way, every number in this business, the ones that make owners rich and the ones that quietly bankrupt them, starts to make sense. There isn't one car wash business. There are 4, and each one is a different bet wearing the same soapy tracksuit. At the bottom, you have the self-serve wash. 4 to 8 coin or card-operated bays where the customer does all the labor with a wand and a vacuum. It's the cheapest way in and the cheapest to run because you're not paying anyone to wash anything. Above that, the in-bay automatic 1 bay, 1 car at a time, and the machine does the washing while the customer sits and waits. More equipment, more automation, still a small footprint. Then the format that has swallowed the industry over the last decade, the express exterior tunnel. Cars load onto a conveyor, get pulled through a wash tunnel in 3 to 5 minutes, and exit to free self-serve vacuums. No hand drying, no interior cleaning, barely any labor. This is the format private equity has bet billions on, and we'll get to why. And finally, the full-service tunnel wash plus interior detailing and hand finishing. Higher labor, higher ticket, and increasingly rare in new construction, because it's the hardest version of this business to scale. Like the gym, the question underneath all 4 formats is the same. Do you make money from a huge number of people paying a little or a small number of people paying a lot? That decision shapes everything else. You'd think the expensive part is the wash equipment. It's part of it, but the real number that shocks first-time owners is land. A self-serve or in-bay automatic can sit on 1/4 to half an acre, which means it can share a parcel with a gas station or convenience store and keep land costs down. An express tunnel needs 0.75 to 1.5 acres with high visibility from a major road, and in a competitive market, that land alone can run anywhere from $250,000 to over $2 million. Then comes construction. A self-serve bay building costs $150,000 to $300,000 to put up. A tunnel building runs $300,000 to $700,000 before you've installed a single piece of equipment inside it. And the equipment is where the real capital goes. A basic tunnel package with conveyor, friction wash, and dryers starts around $500,000 to $800,000, and a fully spec'd system with water reclaim, LED experience lighting, and RFID membership readers can push equipment costs alone past $1.5 million. Add it all up, and a self-serve operation can open for $100,000 to $500,000. An express tunnel, the format actually driving industry growth, runs $1.5 million to $3 million for a modest build, and a large format, prime location tunnel with premium equipment can clear $8 to $10 million before the first car rolls through. This is not a side hustle business anymore. It is commercial real estate with a wash tunnel bolted on, and it needs to be underwritten like one. Water is where the naive plan breaks first. A standard automatic wash uses somewhere between 30 and 80 gallons of fresh water per car depending on the wash type, and every one of those gallons is billed twice. Once as water coming in, once as sewage going out. At 200 cars a day, that's easily 10,000 gallons moving through the site daily, over 300,000 gallons a month. A reclaim system can cut freshwater draw by 50 to 85%, pulling that 50-gallon wash down to 10 or 20 gallons of fresh water. It's not optional in most markets anymore. Plenty of municipalities require it, and it's not cheap. But skip it, and rising water and sewer rates, which have climbed roughly 3 to 4% a year nationally, quietly eat your margin 1 gallon at a time. This is the car wash equivalent of the gym's HVAC formula. An invisible utility cost that the equipment catalog never warns you about, and that shows up as a fixed monthly bill whether or not a single car pulls in. Here's the idea that actually explains this entire industry. Picture a car wash offering two things: a $12 single wash and a $30 a month unlimited membership. Which customer is worth more to the owner? It's the member. Obviously, they wash more often. Members typically visit 2 to 4 times a month, but the value isn't really about wash count. It's that the $30 arrives on the first of the month before a single car has shown up, on autopay, whether or not it rains, whether or not gas prices spike, whether or not the customer even remembers they're paying it. Run the math on a real site. A tunnel doing 50,000 paper wash transactions a year at an $11 average ticket generates about $550,000 a year, unremarkable business against a $1.2 million build. Convert a third of those same customers to a $25 unlimited membership, and that identical piece of real estate generates $750,000 to $900,000 a year. Same building, same tunnel, same land, a 30 to 60% jump in revenue, purely from changing how customers pay. That gap is the entire reason operators will spend $1.5 million on a build that only produces $550,000 in one-time wash revenue. The wash isn't the product. The membership is the product. The wash is just the reason the membership feels worth paying for. Because the whole model runs on recurring monthly payments, churn is the single most important number in this business, more important than car count, more important than location, more important than how shiny the equipment is. Industry churn for wash memberships sits around 7 to 8% annually at well-run operators, and the best-run platforms report monthly cancellation rates as low as 3 to 6%. Compare that to a typical subscription business, and it's remarkably sticky, which is exactly why private equity has been drawn to this sector. Predictable, low churn, recurring revenue attached to appreciating real estate is about as close to the SaaS playbook as a physical business gets. But churn isn't one thing. Roughly 60 to 70% of monthly cancellations are voluntary, a customer actively deciding to cancel. The remaining 30 to 40% is involuntary. A card expires, a payment fails, and the member never comes back to update it, drifting away without ever meaning to leave. Operators now run entire retention systems just to catch that second group before they're gone, because a customer who forgot to update a card is far easier to save than one who's made a real decision to quit. And notice what this means for who your best customer actually is. A member who washes twice a month costs you water, chemicals, and a few seconds of tunnel time. A member who signed up in a promotional push, washes once, and then simply keeps paying because canceling feels like a hassle, costs you almost nothing while contributing the same $25 to $30 every month. It's a quieter version of the same math that makes gym memberships profitable. The unused subscription is often the most valuable one on the book. For most of this industry's history, car washes were small, family-run, cash businesses. That changed over the last 15 years, when private equity discovered that a low-churn subscription business sitting on appreciating commercial real estate was one of the most attractive roll-up targets in America. Firms bought regional operators, standardized them into prototypes, and expanded 50 to 200 new locations a year under a handful of national brands. The clearest example is Mr. Carr Washington. It had been under private equity ownership since 2007, went public in 2021, and by 2026 was taken private again, reportedly delivering its original private equity backers a return on the order of 80 times their initial investment over the life of the deal. Along the way, public shareholders who bought in at the IPO watched the stock struggle to hold its value, even as the underlying business kept growing. The company itself wasn't the problem. Churn stayed low, members kept washing 2 to 4 times a month, and fixed costs stayed a majority of the cost structure. The gap between what private equity earned and what public investors earned came down to when each side got in and what price they paid, not whether the wash business worked. That's the lesson underneath the roll-up boom. A fragmented, sleepy, cash-based industry with real estate, recurring revenue, and low churn is exactly the kind of business that gets bought, consolidated, and resold at a higher multiple each time, and by the time an ordinary investor can buy a piece of it on a public exchange, most of that value has often already been captured upstream. Strip away the financial engineering and the mechanics are simple. Membership revenue plus per wash revenue, minus fixed costs. Take an express tunnel with $600,000 to $800,000 in fixed monthly equivalent costs from labor, debt service, utilities, and software. Most sites don't hit their break-even membership base, usually somewhere around 1,500 to 2,000 active members, for 12 to 18 months after opening, and don't fully stabilize into their real revenue potential for another year after that. Every one of those months before break-even burns through the reserve an owner set aside before construction ever finished. If a competitor opens 2 miles away during that ramp-up window, or a rainy season depresses wash volume right when the site needed early momentum, the runway can run out before the business ever turns a genuine profit, even with full parking lots and a healthy-looking line at the vacuums. In the optimistic scenario, the site is well located, hits its membership target on schedule, holds churn near the low single digits, and runs at 100+ cars an hour through the tunnel at peak. A well-located express tunnel under these conditions can generate $1.50 to $4 million a year in revenue at operating margins of 35 to 50%, 6 to 9 employees total, and returns that are exactly why so much capital has piled into the space. In the realistic scenario, a couple of ordinary things go wrong. Churn drifts toward the high end. A competitor opens on the same commercial strip and starts a price war on monthly membership. Water rates jump 15% after a municipal rate hike. Equipment maintenance runs heavier than budgeted because the tunnel is pushing more cars through than the drivetrain was designed for. None of these are dramatic. No single one would make headlines. But stacked together, they can turn a 40% margin business into a 15% margin business, while the parking lot outside still looks just as full on a Saturday. So if you do decide to open a car wash, remember what actually decides whether you make money. It was never really about how many cars you can pull through the tunnel on a good weekend. It's about how many people keep paying in the months they never show up at all.